welcome back to Prime Wealth. We're really glad you're here with us today.
Yeah, it's great to have you all tuning in. We've got a really exciting topic lined up for today.
Absolutely. So, today we're diving into some key lessons on investing from none other than Warren Buffett. You know, the guy who's like a legend in the investing world.
Right. I mean, Buffett has a way of looking at investments that's just so practical and down to earth.
Totally. And for those of you over 40, this is super relevant because, you know, it's never too late to pick up new strategies to boost your financial future.
Exactly. So we'll be covering things like the importance of long-term thinking, how to evaluate companies, and a few of Buffett's investment principles that can really apply to our lives.
Yeah, and we'll also share some real-life examples so it's not just theory. I think that'll really help it sink in, you know?
For sure. And if you stick around, we'll also chat about how you can start applying these lessons, even if you're just getting started.
Sounds like a plan. So if you're ready to learn some timeless strategies from one of the greatest investors of all time, let's jump right in. So Alex, we've been talking about Warren Buffett and his investment strategies, but I think it's really important to dive into why this matters right now, especially for our listeners who are over 40.
Absolutely, Jordan. You know, when you hit that milestone age, life looks a bit different, right? You're often thinking about retirement, maybe helping kids with college, or even taking care of aging parents.
Exactly. And it's a lot to juggle. I mean, according to recent statistics, people in their 40s and 50s are more concerned about their financial futures than ever.
Right. A survey I saw mentioned that nearly 70% of people in that age group worry they won't have enough saved for retirement. That's a big number.
Yeah, and it's understandable. With rising costs of living and healthcare, it can feel overwhelming sometimes.
And let's not forget about the market volatility we've seen recently. It's enough to make anyone second-guess their investment strategies.
For sure. And, you know, Warren Buffett has this long-term perspective that really resonates with people who are navigating these concerns.
Exactly. I mean, he famously says that the stock market is a device for transferring money from the impatient to the patient.
Right. So for someone over 40, it's like you want to be patient, but you're also feeling the pressure of time.
Yes. And that's why his principles are so valuable. They remind us that investing isn't just about making quick gains. It's about building wealth over time.
And speaking of time, I heard this story about a woman named Linda who started investing in her 40s after attending a workshop. She was really scared at first, but she decided to follow Buffett's advice on investing in what she understands.
Oh, that's a great example. Linda started small, investing in companies she was familiar with, like the ones she used every day.
Yeah, and she didn't try to time the market. She just kept contributing to her investments every month. Now, she's in her 50s and feeling a lot more secure about her financial future.
That's such a good point. It's about creating a habit, isn't it? For many people over 40, starting to invest, or even investing more seriously, can feel daunting.
Totally. But when you see someone like Linda succeed, it's like, wow, that's doable.
And it's important to remember that even small amounts can add up over time, especially with compound interest. Buffett often emphasizes that time is an investor's best friend.
Right, and it's not too late to start, even if you feel behind. There's still time to make a difference in your financial future.
Exactly. And I think that's a crucial mindset shift for our listeners. Instead of feeling stuck or anxious, they can take control of their finances.
Yes! And also, with inflation and economic uncertainty, people are looking for stable ways to protect their wealth.
That's true. Buffett's focus on value investing, finding companies that are undervalued but have strong fundamentals, can really help in uncertain times.
And, you know, it's not just about stocks, right? It's also about understanding how to diversify your portfolio.
Absolutely. It's good to have a mix of assets, including bonds, real estate, and even alternative investments. Diversification can help mitigate risks.
I think it's also important for folks to consider their personal values. Investing in companies that align with your beliefs can be really empowering.
Yes, that's a great point. Buffett always encourages investors to know what they're investing in, so they can feel good about their choices.
And it's about staying informed too, right? Like, following market trends and understanding the economy can really help people feel more confident.
Exactly. And you don't have to be a financial expert to do this. There are so many resources out there now. Podcasts, online courses, and even local meetups.
Oh, I love that. Community can really play a big role in building confidence. People sharing their experiences can be so valuable.
Right? And it's also about having a plan. For those over 40, crafting a financial plan that considers retirement needs, healthcare costs, and legacy goals is crucial.
It really is, and I think those conversations are becoming more common, which is a good thing.
Yes! It's about breaking the stigma around talking about money. The more we share, the more we empower each other.
And it's not just about the numbers either. It's about the emotional aspects of investing, how it feels to take control of your financial future.
Well said. That emotional connection to our finances can motivate us to make better decisions.
So for our listeners out there, if you're feeling overwhelmed or unsure, remember that you're not alone.
Definitely. And, learning from figures like Warren Buffett can provide a solid foundation to build your own investment strategies.
Exactly. And now that we've laid the groundwork, I think it's time to dive into some of those core strategies that can really make a difference for everyone. So Alex, today we're diving into how Warren Buffett invests, right? I mean, who doesn't want to learn from one of the greatest investors of all time?
Absolutely, Jordan. Buffett's strategies are timeless and really practical, especially for folks over 40. I think his approach can offer some solid guidance on how to build wealth over time.
Yeah, and I love that he focuses on simplicity. So what's the first key lesson we should talk about?
Well, one of Buffett's core principles is to only invest in what you understand. He always says, never invest in a business you cannot understand.
Right, that makes total sense. So if someone doesn't get how a tech company works, maybe they should steer clear.
Exactly. It's all about comfort level. If you can't explain how a company makes money, it's probably not a good investment for you. So take your time, do your research, and really get to know the company.
And I think it also helps to think about your own interests or experiences, right? Like, if you've worked in healthcare, maybe investing in health tech makes more sense to you.
Absolutely. That's a great example. Your background can give you insights that others might miss. Plus, it keeps you more engaged with your investments.
So what's the next lesson we should cover?
Another crucial rule is the concept of moat. Buffett loves companies with a strong competitive advantage, something that protects them from competition.
Oh, like a moat around a castle. So how do you identify a company with a good moat?
Right. Look for companies with strong brand loyalty, patents, or unique products. For example, think about Coca-Cola. People have a strong affinity for that brand, which helps it maintain its market position.
And that loyalty means consistent sales, right? So it's not just about the product, but also how people feel about it.
Exactly. And you can also look at companies with a solid customer base or recurring revenue models, like subscription services.
Ah, that's interesting. So the more stable the income, the better for the investment?
Yes, definitely. Stability often means less risk, which is always a good thing, especially as you approach retirement or other financial goals.
Speaking of risk, how does Buffett approach that?
Great question. Buffett's famous for saying risk comes from not knowing what you're doing.
So it's really about education then?
Yes, the more you know, the better decisions you can make. Also, he emphasizes the importance of diversification.
Right, we've all heard that before. But what does that look like in practice?
Well, it means spreading your investments across different asset classes, stocks, bonds, and maybe some real estate. It can also mean diversifying within your stock portfolio too.
So instead of putting all your money in one company, you'd want to invest in several?
Exactly. You want to minimize risk by not having all your eggs in one basket, as they say.
And that's where ETFs or mutual funds can come in handy, right?
Exactly. They allow you to invest in a collection of stocks or bonds, which helps with diversification without requiring you to pick individual stocks.
That sounds pretty manageable, especially for people who might feel overwhelmed by all the options out there.
For sure. And that leads us to another one of Buffett's key strategies. Think long term.
Right. So it's not about trying to time the market or make quick bucks.
Exactly. Buffett often holds on to his investments for years, even decades. He believes in the power of compounding returns over time.
So patience really pays off. Can you give an example of that?
Sure. Take Apple, for instance. Buffett started investing in Apple back in 2016. He saw the potential for growth, and instead of selling when the stock price fluctuated, he held on.
And now it's one of his biggest investments, right?
Yes. It shows how sticking with quality companies can lead to substantial gains over time.
Okay, so we've got understanding what you invest in, looking for a competitive moat, diversifying, and thinking long-term. What else should we keep in mind?
Another important aspect is managing your emotions. Buffett often talks about the psychological side of investing.
Oh, that's so true. It's easy to panic during market downturns.
Exactly. He advises investors to be fearful when others are greedy, and greedy when others are fearful. This mindset can help you make better decisions during volatile times.
So, keeping a cool head is key.
Definitely. It's all about sticking to your strategy and not letting emotions dictate your choices.
And that ties back to knowing what you're investing in, right? If you believe in your investments, it's easier to ride out the ups and downs.
Exactly. And finally, one last rule of thumb is to keep your costs low. High fees can eat into your returns over time.
Right, so being mindful of expense ratios and trading fees is important.
Yes. Look for low-cost index funds or ETFs, and always read the fine print. It can save you a lot over the years.
Wow, that's a lot of great advice, Alex. So to wrap up, we've covered some solid strategies like understanding your investments, finding moats, diversifying, thinking long-term, managing emotions, and keeping costs low.
Exactly, Jordan. And while these strategies are effective, it's also essential to be aware of common pitfalls that investors often face.
Oh, absolutely. Let's dive into that next. So, Alex, diving into Warren Buffett's investment strategies, I think it's really interesting to look at the common pitfalls people face when trying to emulate him, right?
Absolutely, Jordan. I mean, Buffett makes it look easy, but there are definitely some mistakes folks make when they try to follow in his footsteps.
Yeah, like people jumping in without really understanding what they're investing in. I mean, it's easy to get caught up in the hype, isn't it?
Exactly. I've seen that happen a lot. Someone hears about a stock that's skyrocketing, and they think, oh, this is just like what Buffett would do, but they don't actually know the company's fundamentals or even what the business does.
Right. And that's a huge red flag. If you can't explain what the company does in simple terms, maybe you shouldn't invest in it yet.
That's a great point. And, another common mistake is trying to time the market. People think they can predict when to buy low and sell high, just like Buffett did with some of his investments.
Yeah, but Buffett has decades of experience, and he focuses on long-term value rather than short-term fluctuations.
Exactly. He often says his favorite holding period is forever. But so many people get scared and sell at the wrong time. Like during a market dip, thinking they're cutting their losses.
I remember a friend of mine did that. He sold his stocks during a downturn, and then, the market rebounded, and he missed out on all those gains.
That's a classic scenario. Panic selling is a big mistake. Recognizing that market corrections are normal is key. It's part of the cycle, right?
Totally. And speaking of mistakes, what about people who invest without a plan? Like, they just throw money into different stocks hoping for the best.
Oh yeah, that can really backfire. Investing without a strategy or a clear goal can lead to a lot of confusion and regret later on.
Definitely. I mean, I've seen people just follow trends on social media thinking that's a good strategy, but it's really more about being reactive than proactive.
Right. And that's where the danger lies. You can end up with a hodgepodge of investments that don't align with your financial goals. So, it's super important to have a plan.
So how can people recognize those danger signs? What should they look out for?
Well, first, if you find yourself making impulsive decisions, that's a big one. If you're reacting to news headlines or social media posts without doing the research, it's time to take a step back.
Yeah, and maybe take a breather, huh? Like walk away from the screen for a bit.
Exactly. And also, if you're constantly checking the stock prices, that can lead to anxiety and poor decision-making.
I know a lot of people who get super stressed out doing that. It's like, just breathe. You're not day trading here.
Right. And if your investment choices are driven by fear, like you're scared of losing money instead of focusing on long-term growth, that's a warning sign too.
And it's important to remember that even Buffett has had his share of mistakes, right?
Oh, definitely. He's talked about investments that didn't pan out, like some tech stocks back in the day. What sets him apart is that he learns from those mistakes instead of letting them derail his overall strategy.
Learning from mistakes is such a valuable lesson. It's all part of the process, right?
Absolutely. And that's why reviewing your portfolio regularly is crucial. If something isn't working, don't be afraid to adjust your approach.
So it's not about being perfect, but more about being adaptable and staying informed.
Exactly. And remember, investing is a marathon, not a sprint. It's about steady, consistent growth over time.
That's such a comforting perspective. And I think it's important to remind listeners not to be too hard on themselves if they make mistakes.
Yes, mistakes are part of the learning process. The key is to stay curious, keep learning, and adjust your strategies as needed.
So true. And if you find yourself in a tough spot, it's okay to reach out for help, whether it's a financial advisor or resources online.
Right. Seeking professional advice can help you get back on track and develop a more solid plan moving forward.
So to wrap up this section, we've talked about common pitfalls to avoid, like investing without understanding, panic selling, and having no clear plan.
Exactly. Recognizing those danger signs and learning from mistakes can really set you up for long-term success.
And that's what it's all about, isn't it? Building wealth gradually and wisely.
Yes. And now that we've covered these pitfalls, we can transition to next steps. How to create a solid investment plan that aligns with your goals.
I'm looking forward to that. Let's dive into it. So, Alex, we've talked about Warren Buffett's investment strategies, and now, I think our listeners are probably wondering, what can they do today, right?
Absolutely, Jordan. It's all about taking those first steps. So, one immediate action they can take is to, start educating themselves. I mean, there are some great books out there.
Right. Like The Intelligent Investor by Benjamin Graham, right? That's a classic.
Exactly. And I'd also suggest The Snowball by Alice Schroeder. It's a biography of Buffett, and it really dives into his mindset and principles. Plus, it's a great story. So it's not just about numbers.
Yeah, I love that. And what about apps? Are there any tools you'd recommend for someone just getting started?
Oh, for sure. One app I really like is Robinhood. It's user-friendly and great for beginners. They can start investing with just a few dollars.
Yeah, I've heard good things about that one. What about, more traditional options?
Good question. If they want something more traditional, they might consider an app like Vanguard. It's perfect for investing in index funds, which is something Buffett often recommends.
Oh, totally. And index funds are a great way to diversify without needing to pick individual stocks, right?
Exactly. Diversifying is key. So another thing they can do is set up a regular investment habit. Like automatic contributions to their investment accounts.
Oh, that's such a smart idea. It's like paying themselves first, right?
Exactly. It makes it easier. And, it helps build that discipline over time. Even if it's just a small amount, like $50 a month, it adds up.
Yeah, I mean, starting small is totally fine. It's about consistency, isn't it?
Absolutely. And, they should also track their spending. There are some great apps for that, like Mint or YNAB, which stands for You Need a Budget.
Oh, yes. I love YNAB. It's super helpful for creating a budget that actually works for you.
Right? And it helps you see where your money's going. That awareness can really change how you think about saving and investing.
So, let's say someone's ready to start investing. What's the first step they should take?
Well, I'd say, first, they should figure out how much they can comfortably invest each month. Then, they can open an investment account, like a brokerage account.
And, do they need to have a ton of money to open one of those?
Not at all. Many brokerages have no minimum balance requirements these days. They can start with whatever they have, even, $100.
That's so encouraging. And once they have their account set up, what next?
They should take some time to research. Maybe start with ETFs or index funds. They can look for funds that mirror the S&P 500, for instance.
Oh, right. And that way, they're investing in a broad range of companies without having to pick individual stocks.
Exactly. And it's important to keep in mind that investing is a long-term game. They shouldn't get discouraged by short-term market fluctuations.
That's such a good point. It's easy to panic when you see the market drop.
Yes. Staying the course is crucial. Maybe they could, set reminders to review their investments quarterly, but not constantly check every day.
That's so true. And I think having that long-term perspective helps reduce anxiety around investing.
Absolutely. And they can also consider joining investment groups or forums online. Hearing from others can be really motivating and insightful.
Oh, I love that idea. It's like finding your tribe, right?
Exactly. And, they might even find a mentor who can guide them through those early stages.
That makes so much sense. And what about keeping up with financial news? Is that important?
Definitely. Staying informed can help them make better decisions. I'd recommend following credible financial news sources, like the Wall Street Journal or Bloomberg.
Yeah, and maybe listening to finance podcasts or watching YouTube channels that break things down in a relatable way.
Exactly. There are so many resources out there. The key is to keep learning and stay curious about the market.
And I think that helps build confidence too, right? The more you know, the more comfortable you feel.
Absolutely. And, it's also essential to be patient with themselves. Everyone starts somewhere, and it's okay to make mistakes along the way.
That's such an important reminder. So if they take all these steps, they'll be well on their way to investing like Buffett, right?
Exactly. Just remember, it's a journey. Celebrate those small wins along the way and stay committed to their goals.
I love that. So to wrap it up, folks, start small, educate yourself, and remember to stay patient. You've got this.
Yes. And don't forget, it's about building habits that last a lifetime.
Thank you, Alex, for all this great advice. And thank you, listeners, for joining us today on Prime Wealth. We can't wait to see you next time.
Take care, everyone.
Well, Alex, that was a lot of great insights from Warren Buffett today, huh?
Absolutely, Jordan. It's always fascinating to distill his approach into actionable lessons.
Right? So let's recap a few key takeaways. First, it's all about investing in what you know, size forsen.
Exactly. If you understand the business, you're more likely to make informed decisions.
And then there's the importance of patience, like buy and hold, right?
Yes, the long-term perspective is crucial. Buffett emphasizes that time in the market is more important than timing the market.
And we can't forget about the need for discipline. Staying true to your strategy even when things get tough.
Right, that emotional control can really make a difference. And finally, investing in quality companies over time.
Yeah, focus on companies with strong fundamentals. It's not just about the quick gains.
Exactly, and it's about finding value, not just following trends.
So, for everyone listening, if you take away these lessons, you'll be well on your way to building a solid investment strategy.
Definitely. Remember, it's never too late to start. Your financial future is in your hands.
And if you enjoyed today's episode, please like, subscribe, and share your thoughts in the comments.
We'd love to hear from you, especially if you know someone over 40 who could use this advice.
Speaking of what's next, join us next time when we dive into portfolio diversification. You know, the age-old saying, don't put all your eggs in one basket.
That's right. It's going to be a great discussion on how to spread your investments wisely.
So until then, take care of yourselves and keep investing in your knowledge.
Yes, stay curious and stay informed. We'll see you next time.
Bye, everyone.
Bye.